Private equity, the ultimate business hack or legalized asset stripping. So today we're going to take a look at the opaque world that is private equity. I'm going to shed some light on it using a case example of a very interesting opportunity, a unique opportunity as far as I'm aware, that takes the private equity markets and gives you or us as public investors the ability to purchase shares. Guys, disclaimer, nothing I say is advice. You know the drill. I'm not an advisor of any kind. I'm just some crazy guy sharing my takes with the world. Please do like and subscribe to the YouTube channel. I'm nearly at 5,000 subscribers, and obviously I need you guys to subscribe, like, and hit the notifications so that the algorithm gives me the motivation to keep going and my work gets found. So today, guys, I'm using a different setup using Riverside technology. Give me some feedback as to how you like the format, the audio, and all that type of thing. I'm going to be talking today about a recent post that I published on Substack. It's available for free and you guys can access it. There'll be a link in the description. Okay, no paywall, nothing. You can get in there and take a look at what I think about the private equity firm now that is DigitalBridge. Okay, so a little bit of history. DigitalBridge was a REIT, a real estate investment trust. I don't like real estate investment trusts generally because you can't compound your wealth over time. However, if you guys remember and you look on the channel, back when the Geo Group was changing its corporate structure from a REIT to a corporation, this is a very good time to be invested in the business, as it so turns out, because they could now use their earnings. They had more control over their earnings. In a REIT structure, you are obligated past certain points. The operating income has to go and be distributed as distributions. Okay, so you can't pay down your debt. You can't necessarily buy back shares outside of certain peculiar events. You can't necessarily invest in growing the business that way. And so what happens is they usually have to take on a ton of debt, or they have to dilute and issue shares. And then that's not always possible either. It's a bit of a disaster over the long term. So private equity, these guys have sold off all their assets. They've completely rearranged themselves since 2022 as a private equity business, investing specifically in digital infrastructure. So tangible assets that will be involved in everything to do with the digitalization of the world. So telecom towers, centralized buildings, data centers, they're building them. They're doing all sorts of wonderful stuff. And you can check that out a little bit more in the article that I'll mention. So what is private equity first? And then we'll go through and have a look at what I think this thing could be worth. Doesn't have the best reputation in the world. I myself thought about scaling up what I was doing in my 20s to become a private equity fund manager. That was the in thing then, when you had interest rates at like 4%. Private equity, a group organizes themselves. They take on other people's money, so they raise some capital, usually with lockup periods so that they can go and invest in businesses that are private, right? So they don't invest in stocks necessarily. They usually come in, buy out these businesses within a related field. So they might all be in trucking, for instance, and they'll buy up a ton of trucks and freight companies, and they'll fire a ton of stuff if they can. They'll try and condense the depots so that they're all operating with a lower overhead, and they will, through these synergies and M&As, roll up a heap of, let's say, trucking companies. Doesn't matter what it is. They do all sorts of different things. Gain a ton of revenue, slash some expenses to make it a little bit profitable, and traditionally load it with an obnoxious amount of debt. Okay, this makes the IRR in your spreadsheet calculators look amazing. And so then they have two options. They bundle this up as a package and they flog it off to other PE firms or that are bigger than them, perhaps, to public companies, even though the businesses may stay private as a part of their portfolio, or they may go all the way and then take a percentage of that public via flotation. There's lots of different methods that they do it. The structure is you have your fund managers, and they get a ton of capital together and they charge fees, administrative fees, management fees for looking after all this capital. What would we do without our managers? And back in the glory days of like the Howard Marks, not them specifically, but around that era, Steve Schwartzman and David Rubenstein, those types of guys, you were charging 2% assets under management. You were charging 2% of something called carried interest. In the US, they have a general partner and then limited partners that would be investors in the fund. And so carried interest, once they had achieved, these private businesses, let's say, achieved a rate of return over an agreed high watermark or hurdle rate, let's say 8%, 10%, whatever it is, the return over that, which you imagine if they're rolling these things up over a few years, levering them up, they can be getting super amazing IRRs, selling businesses, selling buildings, whatever the case may be. And obviously then they get a clip of the profits as well, usually 20%. It's a very good business model as far as the private equity guys go. Let's take a look and see if I can work out how to share my screen on this thing. I'm sure it's good technology. It's whether I can use the technology that's a whole nother question. Here we go. So you'll see in this particular article here, DigitalBridge. Okay. What I wanted to talk about is something. I explain this the structure a little bit further. These guys, where they're at, they've sold down and rotated basically completely now. So they do not have the same amount of capex that they used to. Capital expenditure, you can see here, 2022, that was the last year of them winding up their operations as a REIT. Okay, you can follow my cursor here. Hopefully you can see that. From here now, moving forwards, you can see that their capex is a fraction of what that will be because it's a totally different operating model. It's now, believe it or not, a capital light model. They use a ton of capital, but it's not their capital. I think that's a very important point. I only want to draw your attention to cash from operations coming in at roughly 320 million next year is expected by the analysts. I think that's a bit low. I think they'll be able to make that in fee generating revenue alone. Additionally, we can see their net debt has been completely cut down, and so they've got about a quarter of what they used to. They can continue to pay down some of that. They probably won't do it to this degree. I don't think that's going to be accurate, but they can de-lever at the same time that they're ramping up and hitting scale, not just with the fee management or the fee revenues of their business, but also what the businesses that they are invested in continue to hit scale. Okay, so market cap today 1.9 bill at 3.3 billion enterprise value. Okay, so that's all pretty good. No real risks on the balance sheet as far as I can see here. In the article, I take you guys through just how much capital these guys have been able to raise since 2022. They're at nearly 35 million. And they had 1 month here where they raised basically 2 billion in a month. Where they get that capital from, usually from pension funds and institutions. So they got Australian Super, amongst others. They invested 2 billion in one and only one of their projects alone, which is pretty incredible when you think about it. So here we can see, and I want to draw this to your attention. We've got 7 billion this year total fee earning equity under management. Okay, they use this acronym. It's a horrible acronym. Basically, funds under management of which they can charge fees is already at 34 billion, and it's growing at a rapid clip. I love what they're invested in, but I like the capital light model even better. Okay, so I want to be able to buy an ownership in this 34 billion of assets that's growing year on year on year, and I'm clipping the ticket at sort of 1% on that every year. Now, you'll be doing the math there, and you think 1% of 34 billion under assets, that's 340 million, basically guaranteed year on year, and it's going to grow. The fees will grow as the capital under management grows. And you think to yourself, holy moly, that's roughly a 10% enterprise value yield just based on a loan. On what we saw, 3.3 billion enterprise value, 1.9 billion market cap, and 340 million in fees. That's amazing, but not so fast, because remember, this is private equity we're talking about here. From that fee generating revenue, there are a few little lines here in the expense column, which I don't like quite so much. What happens here is they pay themselves compensation expense, cash and equity based. Not ideal. Okay, that's a big part of the revenue that you can see. More than half is going, as far as I'm aware, I'm reading this as cash expenses and equity expenses that are going to the managers themselves. So an outside investor today is not necessarily getting all of this 300 management. So it's an interesting idea. I want to see how this picture plays out over time. Now, compensation expense, they have some clawbacks. So what can happen is if they don't hit their targets quarter over quarter, they can charge fees, but then in the next quarter, if they don't hit the targets, they can actually have those fees clawed back by the limited partners, so the private investors invested in this fund. Working through here, this is illustrative of the type of potential for this particular business. So you've got your fee revenue that's growing 16% year on year from 23 to 24, which is pretty darn good. Okay. If we can get 340 million of the fees and it's growing at double digits, that's really, really an amazing opportunity. We'll see how much of that drops to the bottom line. Fee revenue margin also increasing, so that's good. Question will be, how much of this is really going to drop to the bottom line for us as outside investors at the end of the day? What I'm thinking to myself, I really want to buy the fees. I get a call option on all the wonderful stuff these guys are investing. So if you look at one of their good quarters and kind of smooth out the numbers, you'll come up with a distributable income per share, basically. Okay, so distribution per share. And if you annualize some of these at the last 12 months run rate, you're looking at roughly $1.12 per year in fees distributed to you alone. So not the total fees, but the fees that you're actually getting as an outside investor. So that's very interesting. 11% yield on a capital light recurring revenue business with it is very good alone with all these extra call options. It's interesting. It's caught my attention. Every now and then you'll see these lumpy earnings in the carried interest column. So that's where they've made profits on certain businesses. They might be selling and flipping some assets, whatever the case may be, over and above the hurdle rates. And that, of course, is carried interest. So they get a percentage of that, and it shows up in this carried interest column. This can add quite a bit to the fees that will be distributed in that earnings period. Okay. So, what kind of multiples should this business attract in the market? Remains to be seen. There's another company, a Canadian company called Brookfield, and they're a really, really huge private equity firm. If you take a look at the Carlyle Group, which is David Rubenstein's, if you look at Blackstone, Steve Schwartzman, Pete Petros' private equity firms, then you think to yourself, have they got the ability to grow at this type of run rate? You might start to play around with some different multiples on where and decide for yourself whether you think an 11% earnings yield is appropriate. So when we take a look, over the last 5 years, the stock price has been absolutely smashed. But remember, up until this line in the sand here, 2022, it was a completely different business model. Okay, so I think when you go in and you look at, and this has an updated, why is it updated? Here we go. So when we look at things on a shorter time frame, okay, so 1 year, stock's going up, it's going down, it's all over the shop. It's still down 33% over the last 12 months. But if you take a look at this recent spike in the year to date, it's up almost 10% year to date. I think people are starting to figure out that it's not the same business that it was. So that being said, guys, I've already talked a little bit too much than what I had in mind. If you're interested in learning more, obviously you can click the link in the description, go in and have a look at the Substack. And I hope you enjoyed that for today, guys. If you like these, make sure you like and subscribe to the YouTube channel, join the free list on Substack, and you get access to all the free material. Take care, and I look forward to catching up with you for another episode in the ROI Club. Cheers.